Retail sales for March jumped 0.9%, falling short of the 1.1% rise economists expected and eclipsing February's 0.6% decline. So what does this mean for the Federal Reserve as it prepares for its first rate hike since 2006? Well, let's bring in Jeff Greenberg, senior economist at JP Morgan Private Bank. And Jeff, we'll talk about the Fed in a moment, but first, your reaction to the numbers, of course, missing expectations, but still higher than the previous month.
Right. I do think that it's an important report because it's the first positive number we've seen since November. It was a little bit weaker than expected, but I think the mix of consumer spending within it is pretty healthy. Things like building materials picked up, auto sales bounced back, and tells us that even though consumers aren't spending all of that energy surplus, they are starting to spend some of it.
Right, well, food services only rose 0.7%, so you would think that with those low gas prices, that extra money would be going to more recreational expenditures like restaurants. I mean, haven't gas prices been low for long enough for consumers to finally start spending that extra money? I mean, shouldn't we be seeing more of this?
I do think that we may not be seeing it as much in things like food services, but it is starting to impact those big ticket items, things like vehicle sales, luxury, bigger, fuel usage vehicles. We are seeing, a pickup in things like the building materials I mentioned, which tells us that people are, reinvesting in their homes, and those are the categories that I think matter more and are more, important for the longer-term sustainable growth. So if they're not spending at restaurants, it's, not too disconcerting because they are starting to spend on those big purchases.
All right, and what does this mean for the Federal Reserve? Of course, each piece of economic data will be looked at more carefully given the central bank's looming policy shift.
I think today's report is in line with what the Federal Reserve needs to be on track to hike rates later this year. They were expecting a bounce back. We did get some of that. It doesn't mean that we're there. I think we'll need to see further improvements in the labor market, a further decline in the unemployment rate to get to the September hike we expect. But this report fits in line with what the Fed needs.
All right, so your outlook hasn't changed in terms of timing, but what about, of course, that weak March jobs report coupled with this report? Do you still see September as the timeline, or have you guys pushed out to maybe December or 2016?
September is still our base case, but I agree that reports like the March unemployment report tells us that there's a risk of it being later as opposed to sooner. And so I do think June is now definitely off the table. September is there, but the risk is that they go later, or even if they do hike in September, they do it at a gradual pace.
All right, Jeff Greenberg, we'll leave it there. Jeff Greenberg, senior economist at JP Morgan Private Bank. Thanks for coming on.
As well, thank you.
I'm Scott Gamm, and you're watching The Street.